Hello, welcome to today's video. Let me ask you something. You're doing the right things. You're earning a solid income, maxing out your 401k, maybe investing on the side, and staying on top of your financial life. You've probably been told that if you just keep going, retirement will take care of itself. But here's the truth. Most people don't realize until it's too late. It's not just about what you say, it's about what you keep. There's a hidden risk that could quietly chip away at your future retired income, and most people never see it coming. I'm talking about taxes in retirement. Not just the taxes you're paying now. I'm talking about the tax bill waiting for you decades from now when you start withdrawing from those tax-deferred accounts, when Social Security kicks in, when your Medicare premiums start climbing because of something called an IRMAA. Here's the part no one tells you. Many high-income professionals in their 30s and 40s are unknowingly building a future tax bomb because the very accounts that you're using to save today are setting you up for higher taxes tomorrow. But the good news, if you understand how retirement taxes actually work, you can start building a strategy today to help reduce that future burden and create more financial freedom down the line. In this video, I'm going to walk you through the biggest retirement tax traps most professionals don't see coming, why saving more isn't enough, and how you can start designing a tax-smart retirement plan now while you're still in your prime earning years. Hi, if you're new here, I'm Nathan Seeley, the founder of Brass Ring Wealth Management. For over 2 decades, I've helped professionals in their 30s and 40s build financial strategies that actually align with the real-life decisions they're making. Career moves, business growth, family planning, and early retirement goals. And the one thing I've seen over and over again, most people don't factor taxes into their long-term wealth strategy until it's too late. This video is here to change that. We're going to break down the often overlooked tax risks hiding inside retirement plans, and more importantly, how to get ahead of them while timing's still on your side. The myth of lower taxes in retirement. Let's begin with one of the most common assumptions professionals make when thinking about retirement. I'll be in a lower tax bracket when I retire. This idea is everywhere. It's been passed down from prior generations and baked into a lot of traditional financial advice. At first, it makes sense. If you're no longer earning a salary, your income must go down, and so will your taxes, right? Not always. And for high-income professionals, especially those who have done a good job saving, that assumption could be dangerously misleading. Here's the part that often gets missed. Just because you stop working doesn't mean your tax liability disappears. In fact, many of the income sources you'll rely on in retirement are still subject to taxes. And depending on how you've saved, you could find yourself paying more in taxes than you expected, sometimes even more than when you were working. Most retirees rely on a combination of income sources like withdrawals from traditional 401ks or IRAs. Those are taxed at ordinary income. Social Security benefits, which can be up to 85% taxable, depending on that income. Pension income, if applicable, is also taxed as ordinary income. Investment income like dividends and capital gains, rental or business income, which can push your total tax burden higher. If you built a strong retirement portfolio and tax-deferred accounts, you could be looking at substantial required withdrawals and substantial taxes down the road. Let's walk through a quick example. Let's imagine you retire at 65 with $1.2 million in a traditional 401k, a modest Roth IRA, and some taxable investment. You also expect about $40,000 per year from Social Security and $10,000 in annual dividends or rental income. To support your lifestyle, you withdraw $50,000 from your 401k. Now, add in the Social Security and the $10,000 investment income, that brings your total annual income to $100,000, most of it taxable. And when you turn 73, RMDs kick in. That means you're now legally required to take a certain amount of your traditional IRA or 401k every year, regardless of whether or not you need it. That added income can increase your taxes further and potentially trigger Medicare surcharges or higher capital gains rates. There's also another tax surprise that catches people off guard: the shift to single tax filing in retirement. Let's say your spouse passes away. Your household income doesn't change much, but your tax filing status does. As a single filer, your tax bracket shrinks, meaning more of your income gets taxed at a higher rate. So even though you're technically earning less than you did during your career, your tax rate might not go down at all. In some cases, it can go up. All of this is happening in a tax environment that may not stay where it is. The current individual tax brackets were lowered under the 2017 Tax Cuts and Jobs Act, but those cuts are set to expire in 2026. If Congress allows that to happen, we could see tax rates increase for many Americans, especially those in the higher income bracket. And that's without considering future legislation. With national debt levels rising and entitlement programs like Medicare and Social Security under pressure, there's a reasonable chance the tax rate could increase again over the next few decades. So if your retirement plan is built on an idea that taxes will be lower in the future, it may be time to reevaluate. Why does this stick around? Well, because for many retirees, retirees in the past, it was true. They lived in on Social Security and had a payoff house. They didn't draw heavily from their savings. Their expenses dropped, their lifestyle simplified, and they paid less in taxes. But high-earning professionals in their 30s and 40s today are planning for a very different kind of retirement. You're saving more, you're building more, and you're planning for a life that doesn't feel like a downgrade. That means the traditional retirement tax advice may not apply to you. Here's the bottom line. Taxes are one of the largest and most controllable expenses you'll face in retirement. But the key is planning for them early. That means understanding which accounts will create taxable income later, modeling how your withdrawals will impact your future brackets, prioritizing tax diversification, and having a mix of tax-deferred, tax-free, and taxable accounts. Considering strategies like Roth conversions while you're still in a lower bracket. The earlier you understand how taxes actually work in retirement, the more control you have over your income and your options. Why tax diversification matters. Most professionals understand the importance of investment diversification. You spread your assets across different asset classes, stocks, bonds, and real estate, so you're not overexposed to any one type of risk. But there's another kind of diversification that's just as important and often overlooked: tax diversification. Tax diversification means having your retirement savings spread across different tax buckets, each with its own set of rules and how and when those funds are taxed. Let's break it down. Tax-deferred accounts, traditional 401k, traditional IRA, these are accounts that most people focus on because they offer an immediate tax benefit. Your contributions reduce your taxable income today, and your money goes tax-deferred. But eventually, the IRS wants its share. Every dollar you withdraw in retirement is taxed as ordinary income. The problem, if most of your retirement savings are in tax-deferred accounts, you're creating a future tax liability. And once RMDs begin at age 73, you don't have much control over how much income you're forced to take and pay that tax on. 2. Tax-free accounts, Roth IRA, Roth 401k. You don't get the deduction when you contribute to a Roth account, but qualified withdrawals are completely tax-free. That means no taxes on the growth, no taxes when you take the money out in retirement, and no RMDs for Roth IRAs. Roth accounts are incredibly powerful tools for long-term tax planning. The most high-income earners don't have nearly enough saved in them. That's often because Roth IRAs have income limits, but there are still ways around that, like a backdoor Roth contribution or Roth conversion. 3. Taxable accounts, brokerage accounts. These accounts don't offer any upfront tax break, and you'll pay taxes on interest, dividends, and capital gains. But they also offer the most flexibility. You can access the money anytime for any reason without early withdrawal penalties or RMDs. Taxable accounts also give you more control over your income in retirement because you can sell the investment strategically to manage your tax bracket. Here's why tax diversification matters so much in retirement. Let's say you want to withdraw $100,000 in retirement. If all of that comes from a traditional IRA, that's $100,000 of taxable income. If you can split it between a traditional IRA and a Roth IRA, you might only show $50,000 in taxable income, keeping you in a lower bracket and avoiding those Medicare surcharges. If you also have a taxable account, you can harvest capital losses or tap into long-term gains with preferential tax treatment. Tax diversification gives you that flexibility. It gives you choices. And in retirement, choices are what keep your plan resilient, especially in a changing tax environment. Most people don't think about it until it's too late. They max out their 401ks, say nothing in Roth accounts or brokerage accounts, and then hit retirement with one tax-heavy option. Start taking money out and paying the bill. But with proactive planning in your 30s, 40s, and 50s, you can build a more balanced, tax-efficient strategy that gives you more control later. Coming up next, we'll walk through how to begin building that strategy, how to build that tax-smart retirement strategy starting now. So you understand the importance of tax diversification, but the next question is, how do you actually build a tax-smart retirement plan when you're still in your peak earning year? The key is to take strategic action now while you still have time, income, and flexibility on your side. Here's how to get started. Understand your current tax bracket and your future one. Before making decisions about Roth versus traditional accounts, you need to understand your current and projected tax brackets. Ask yourself, are you in a high tax bracket today and expect to be in a lower one in retirement? Or will your income and tax rate likely stay the same or even increase in retirement due to RMDs, Social Security, and pension income? If your income is lower now, Roth contributions or conversions may be more appealing. If you're at peak earnings, traditional pre-tax contribution can make sense, but only if you have the plans to manage those taxes down the road. Don't guess here. Pull your tax return, calculate your marginal and effective tax rate, and forecast your expected income trajectory. Contribute across multiple tax buckets. This is one of the simplest ways to build a tax flexibility, contributing to multiple types of accounts. If your employer offers a Roth 401k option, consider splitting contributions between Roth and traditional. Max out your HSA if eligible. It's the only account with triple tax advantages: pre-tax in, tax-free growth, and tax-free withdrawals for qualified medical expenses. Start investing in a taxable brokerage account, even if it's just a few $100s a month. It's not about choosing just one account type. It's about spreading your contributions to create options later. You should also also consider Roth conversion. Strategically, if you have a traditional IRA or 401k, you might consider converting some of that money into a Roth. Why? Because once it's in a Roth, it grows tax-free forever. But Roth conversions are taxable events, so timing matters. Some smart opportunities for Roth conversions in years where your income dips, like after a job change, a sabbatical, or a business loss. After making out deductions or credits that lower your taxable income, early retirement years before you claim your Social Security or RMDs. The goal isn't to convert everything at once, it's to gradually move money from tax-deferred to tax-free while staying in a manageable bracket. Use tax-efficient investment strategies. This is where you have a thoughtful investment plan that ties into your tax plan. Ask yourself, are you placing the right assets in the right accounts? Are you minimizing short-term capital gains? Are you taking advantage of tax loss harvesting in those brokerage accounts? Are your mutual funds generating unwanted taxable distributions? Asset location, which is the decision of what to own where, can sometimes make as much impact as an asset allocation. For example, bonds or REITs that throw off regular income may be better in an IRA. Stocks with long-term growth potential are often more tax efficient in a Roth or brokerage account. Actively managed funds that generate frequent capital gains can create surprises in a taxable account. It's not just about what you invest in, it's about where you invest it. Model future scenarios. One of the most overlooked parts of tax planning is stress testing your plan against future scenarios. Try asking what happens to your tax bracket if you retire at 60 and start drawing from your IRA at 73. How much will Social Security push up your income? Will your portfolio withdrawals trigger IRMAA surcharges on Medicare? If tax laws change in 2026, how will that impact your future withdrawals? Working with a financial planner or even running basic projections using planning software can uncover blind spots and help you make better decisions today. Because these decisions you make in your 30s, 40s, and 50s will determine how much flexibility you have in your 60s, 70s, and beyond. Retirement planning isn't just about how much you save, it's about how much you keep, and taxes are one of the most underestimated threats to your future income. The good news is, by taking time now to understand your income, investments, and withdrawal strategies and making them work together, you can build a retirement plan that offers both clarity and flexibility. This isn't about having all the answers today. It's about building a strategy that gives you options and puts you in the driver's seat. If you're ready to create a personalized retirement strategy that helps you keep more of what you worked hard for, I invite you to book time with my team using the link in the description below. We'll walk you through your goals, your current plan, and where tax opportunities may exist based on your situation. Let's make sure your money works as hard for you in retirement as you work to earn it. Thanks for joining.